Hey, what's up, guys? It's Jonathan here. Oh my goodness, I think we just got a CPI reading that will absolutely change the direction of the market. So let's get into it. So last month we got a reading of 0.4% increase month over month and an 8.2% year over year increase. And that was for the reading in September. So the expectations for this October reading was that we'll get a month over month reading of 0.6%, a year over year reading of 7.9%, a core month over month of 0.5% increase, and a core year over year increase of 6.5%. And this higher month over month read is justified by the job numbers that we've gotten earlier on in the year. If you watch my video on the JOLTS report, you would see that we did have a pretty increase. Did have an increase in job openings, which caused more pressure on wages. So again, more pressures on wages, more pressure on inflation. But even though we had those high expectations, our actual readings for this month were actually really good. So we got a 0.4 month over month reading, which was the same as what we got in September. And that was a beat on expectations by 0.02%. We also got a 7.7 year over year reading, which was the smallest year over year reading that we've had ever since January of 2022. Then for core, we got a 0.03% month over month reading, which is half of the month over month reading that we got in September at 0.06. And our year over year core reading was 6.3%. So for October, shelter accounted for over half of the monthly increase, with 0.8 month over month increase. To explain how CPI works, pretty much the way they get to their month over month or the year over year overall number is that they'll give certain sectors or certain inflation sectors a weighted. So for example, shelter makes up 32% of CPI. So that means that 0.8 month over month is multiplied by 0.03. So that would be the weighted increase, and then all the weighted increases for all the different categories are added up, and that's how they get that headline number that you see on like newspapers or on TV or wherever you get your news from. So shelter played a big role, but we are starting to see that shelter inflation is starting to come down with some of the reports that we've seen of a softer rental market. We're seeing rentals stay on the market for longer. And because of that, we're seeing prices start to come down in rents. Or we're starting to see the price increase in rents start to slow down. It's very difficult to see rent prices go down just because rent prices are very sticky. So once they go up, they usually tend to stay up. But then that can also depend on a bunch of different other things that have to do with the real estate market. But this isn't a real estate video, so let's not get into it. Anyways, because we have just recently started to see that inflection point in rents, it's going to take some time until that shows up on CPI reports. But that is a good sign overall for the longevity of us seeing inflation start to come down. So also we saw increases in gas and food costs month over month as well. Food from home was up 0.6% month over month, whereas out was up 0.9% month over month. And this makes sense considering the jobs report that we got. We did see a massive increase in job openings for restaurants and hospitality. So we were expecting to get a high number when it came to food out as well. And in my opinion, I think that's kind of like the final pillar of inflation. Pretty much almost everything else is starting to slow down inflation wise, but we are still seeing the cost of food out and the cost of hospitality stay relatively high and continue to increase. And again, like I said, with the jobs, we are seeing those job openings show up a lot more and increase a lot more than any other sector. So we probably won't see that start to deflect down until we start to see people not only run out of the savings that they built during the pandemic, like during lockdowns and everything, but also we start to see them burn through available credit. And then at that point, I think we'll finally start to see a U-turn, even though it's like from a personal finance perspective, it's absolutely terrible. But that's when we will start to see that rotation down in inflation. Gas was up 4% month over month, but year over year, energy is up 17.5%, and food is up 10.9%, which is both lower increases compared to the readings that we got in September. So again, that's a good sign that we're starting to see inflation start to deflect downwards. So energy costs did increase 1.8% month over month overall, which again, gasoline, which went up 4% month over month, but it was really driven by fuel oil like kerosene that people use to heat up their homes in winter. And that went up almost 20% month over month as people start to prepare for the winter ahead. Natural gas didn't decrease. It went down 4.6% month over month, whereas new cars went up 0.4% month over month, which is a little surprising given the fact that we saw so much softness in the durable manufacturing job sector. But we may start to see this turn to the downside very quickly in future reports as we start to see the demand for cars start to cool off. Now, and then for used cars, we actually are starting to see that cool off in the CPI data. It's currently down 2.4% month over month, which makes sense because, again, with the job numbers that we saw and the decrease in durable manufacturing, that would make sense. And also just kind of what we're hearing from people in the business that we are starting to see inventory start to pile up, especially for used vehicles. So we expect to see we do expect to see more slowness in the used car market as well. So when it comes to airfare is actually down for month over month 1.1% seasonally adjusted. And this is actually a good sign because airfare cost was a pretty big driver of inflation earlier this year. So some interesting ones that I saw that I wanted to share was that lunch meats are up 3.4% month over month, while eggs are up 10% month over month. Salad dressing is up 4.1% month over month. And laundry equipment, which is another durable, is actually down 7.8% month over month. And which is a little bit more in line to what we saw with the jobs report earlier this month. Hotels are up 5.6% month over month, which is interesting because airline prices are coming down, but hotel prices are going up. So it's a little interesting of a difference that we have going on there. The whole reason why we're even focusing on CPI is because what we see in the CPI reports affect what the Federal Reserve does with interest rates. And what the Federal Reserve does with interest rates directly affects the stock market and the real estate market as well. The whole reason why we're even focusing on CPI is because what we see in the CPI reports affect what the Federal Reserve does with interest rates. And what the Federal Reserve does with interest rates directly affects the stock market and the real estate market as well. Before the CPI print, we had a 57% chance of a 50 basis point hike in the December FOMC meeting. Now, after this report that we got, we now have an 80% chance of a 50 basis point hike, which pretty much what fueled the crazy rally we saw on Thursday in the stock market. So my thoughts, overall, this was a really great report. Now, a warning I will say is that inflation could go up on the next report that we get for November and December. So it is important for us to continue to see this downtrend. And also it's really important because I don't necessarily know if this is the best. I can't give you financial advice, but I'm not sure that if this is the best time to go all in. It very well could be if we get a lower read, but if we get a higher read, we could see more softness in the market. So it's kind of one of those things where it's like, yes, it's great, but we really need to see more reports like this in concession before we could really start to see okay, inflation is not going up anymore, and the Federal Reserve is going to slow down their rate hikes. Like I said earlier, I think that the last pillars to fall really are food and travel when it comes to inflation. And it seems like we are starting to see some weakness in travel when it comes to airline fares. So that is something we want to look out for. And we also want to see food slow down over the next couple CPI readings as well. And we are starting to see softness in airfare, but we aren't seeing that same level of softness in in lodging. That to me, that tells me that people are now still traveling a lot, but they're not traveling by air so much. They're more maybe doing road trips and staying in hotels in different places. That's kind of the read that I get from that. It could also mean that people are just starting to run out of money. So now instead of them traveling across the country, now they're just going to travel like on a 2 hour drive like down the street from them. Food is still strong, but like I said, I really think that once people start to exhaust their savings and they start exhausting their their available credit, then I think that's when we'll finally start to see food inflation start to come down. And once food inflation starts to come down, that's pretty much, we've already made a case for shelter inflation coming down, and those are the two like big drivers of inflation at this point. So I'd like to thank you guys so much for watching, and I'll see you in the next video. Peace.